This is probably the most important concept that we're going to talk about in this chapter. Product and period cost. So product cost includes the cost of purchasing or making a product. So that's going to be your direct materials, your direct labor, and your factory overhead. So these items are going to be added to the cost of inventory. They're not going to be expensed until we sell them in inventory. So if it's a product cost, it will be included in inventory. Period costs are going to happen outside the manufacturing plant. And like selling and administrative expenses, other expenses such as tax and interest, they're not going to be added to the cost of inventory. Instead, they're going to be expensed as a period cost. So you can read over these, but selling expenses and admin expenses, those are just a few examples, but anything that happens outside of the manufacturing plant would be a period cost, and period costs are expensed. So here are some examples of some period and product costs. So you can see here. So let's just recap here for a minute. So product costs are capitalized through the inventory. That means they're added to the inventory, and we don't expense them until the inventory is sold. But period costs are expensed immediately in the period that these expenses are incurred. Okay, so let's look at the period costs outside the plant here. Selling expenses, advertising expenses, commissions expenses, those are selling expenses. And then admin expenses, office salary expense, office supplies expense, depreciation expense of the office building and the equipment in the office. These are all going to be expensed. Contrast that to product cost at the top. These are manufacturing costs. They all happen inside the factory. They include your direct materials, your direct labor, your manufacturing overhead. And we're first going to put them into inventory. And remember, inventory is an asset. Remember, we're going to have 3 groups of inventory. One's going to be raw material, then work in process, and then finished goods. Okay, and we're going to talk more about that. So if it's a category of inventory, that means it's an asset, and assets are not expensed until they're sold. Okay, so where does inventory, where's inventory recorded? Well, it's an asset, and assets are on the balance sheet. So product costs are part of inventory. Inventory goes on the balance sheet. And then when we sell the inventory, it's going to go into the cost of manufacturing products sold, or the cost of goods sold on the income statement. Period costs, however, are going to be expensed immediately on the income statement in the period in which they are incurred. So period costs never appear on the balance sheet. This is a great visual. These PowerPoint have so many great visuals if you're a visual learner. This is the flow of cost for the purpose of generating revenue. So you see how product costs go into inventory on the balance sheet first, and then they don't go onto the income statement until they're sold. But the period costs go straight to the income statement in the period they are incurred. Okay, so here's an example to go through and make sure that you understand. So you can see here that leather used to make a baseball glove, that happens inside the manufacturing building where it's made, so it's a product cost. Cost of endorsement from a professional baseball player, that's going to happen outside the manufacturing plant, so that's period cost. Office supplies used at the company's headquarters is in the office, that's going to be a period cost. Ink used to print a player's autograph on the glove, that's going to happen in the manufacturing plant, so that would be a product cost. So now we're going to look at the financial statements for a manufacturing business, and mainly we're going to look at the difference in the balance sheet and the income statement because they're a little bit different. And we're also going to look at a new statement called the cost of goods manufactured. So if we were a service company, we would not have any inventory. If we were a merchandising company, like up here at the top, we would only have one inventory called merchandise inventory. And then down here, a manufacturing company has three types of inventory. Raw materials, or here it's listed as materials, work in process inventory, and then finished goods inventory. So the income statement is going to look somewhat similar, but there may be a few new accounts. For a service company, we just got revenue minus expenses. But for a merchandise company, we still are going to have revenue, but we also have this cost of goods sold because that's our biggest expense usually. How much did the goods we sold cost us? That's what cost of goods sold is. And then net income or operating income. So let me scroll down and look at a little bit more. Okay. So a merchandising business is going to purchase merchandise already made, and they're going to turn around and sell it. So it's ready to sell when they get it. So what they're going to have is they're going to have beginning merchandise inventory plus anything they purchased throughout the year. And that's going to give us the merchandise that's available for sale. But the cost of merchandise sold is going to be, you're going to take all the costs of your merchandise available, subtract out what's still there, and that's going to give you your cost of merchandise sold. All right. So here's a look at the differences here. All right, so let's just look at it again. So for the merchandising company, we have revenue, which is sales. All right, and then we just talked about how to get this number to the cost of merchandise sold. And when we subtract it out, that's going to give us gross profit. Now this is not the entire income statement. This is just a part of the income statement that gets us to gross profit. Then for a manufacturing company, okay, we're still going to have cost of goods sold. But to get to it, instead of merchandise inventory, I'm going to start with beginning finished goods inventory plus anything I made during the year. Instead of anything I purchased, it's anything I manufactured. So what's already there plus what I made during the year, and that's going to give me my amount available to sell. Subtract out anything still in finished goods to get to cost of goods sold. So it's a similar situation here, except here I'm making the goods. Over here I'm just purchasing the goods and turning around and selling those. So here is the how to calculate the cost of goods sold or the cost of goods available for sale. So a manufacturer makes the product it sells, so this is for a manufacturer. And the total cost of making products that are available for sale is called the cost of goods manufactured. Remember, with merchandising, we would say the cost of merchandise available for sale and the cost of merchandise sold. Well, now we're not talking about merchandise. We're talking about manufactured products. So you're going to start with everything that's already in finished goods. This is anything sitting there that we had from last year or the last period that we did not sell. Then during the period, we're going to make more, and that's going to be our cost of goods manufactured. And when we add what's in inventory to what we made during the period, that is the cost of finished goods available for sale. So how do you figure out the cost of goods sold? You take all your goods that are available for sale and subtract out anything that's in ending inventory that we did not sell, and that gives you your cost of goods sold. So the income statement for a manufacturing business requires a calculation of how to figure out the cost of goods manufactured. So what this is this determines the cost of goods sold, and we need that number to prepare the income statement. So that number, that cost of goods sold number, is calculated in this statement that is called the statement of the cost of goods manufactured. The steps to determine the cost of goods manufactured: first, you have to determine the cost of the materials used, and then determine the total manufacturing cost, and then you can determine the cost of goods manufactured.